Hey everyone, and welcome to this explainer. Today, we're diving deep into a fascinating, highly practical text called The 5-Minute Investor. And listen, our goal today is pretty simple, but honestly, it's kind of radical. We're going to completely unlearn basically everything we thought we knew about the stock market. So get ready, because we are rewriting the rulebook and clearing out all those bad habits that are probably holding back your portfolio. So think about this for a second. What if everything you've been taught about the stock market is actually guaranteed to lose you money? I mean, it sounds a little crazy, right? We've all heard the traditional, super comfortable advice, mantras like buy low, sell high. But what if that exact piece of comfortable advice is silently destroying your wealth? Today, we're really going to unpack the cognitive dissonance behind these widespread lies, and we'll see exactly why doing what everyone else does gets you exactly what everyone else gets. Okay, let's dive right in. Section 1, Stock Market Myths Busted. Right off the bat, we have to clear out the foundational lies before we can build a truly profitable strategy. So let's tackle the biggest myth of them all. Is the stock market literally just a giant casino? Is it just gambling? Now, this is a massive fear, especially for beginners. The author even points out hearing a so-called economist on a national radio broadcast actually equate investing with gambling. It's a really pervasive idea, but honestly, it fundamentally misunderstands how markets actually work. Here's the deal. Just look at the stark mechanical contrast between the two. Gambling? That's a zero-sum game. Every single dollar you win is a dollar lost by someone else. It produces absolutely nothing. Investing, on the other hand, is positive-sum. When you buy stocks, you are providing seed capital to real companies to produce actual goods and services. Because you're fueling production, aggregate wealth is created for society as a whole. And that right there is exactly why the stock market trends steadily upward over time.
Moving right along, Section 2, the prediction trap.
There's this huge illusion that highly paid financial gurus can actually predict short-term market movements. We all crave certainty, so naturally we pay these prognosticators to tell us what's coming next. But if you really want to beat the best minds on Wall Street, just wake up each and every morning and make this astonishing prediction. The market will be up today. Seriously. Because the stock market spends the vast majority of its time advancing rather than declining, this one simple daily mantra gives you about a 60% accuracy rate. That alone allows you to handily beat most of those highly paid advisors.
All right, Section 3, Rethinking Price and Value. Now we're going to systematically attack the core logic behind those buy low, sell high mentalities that trap so many investors. First up, the myth that what goes up must come down. Okay, sure, gravity is an absolute truth in nature, but in the stock market, aggregate value trends upward, and those gains eventually become permanent. Think about it this way. The Dow Jones Industrial Average hit a level of 50 back in the 1930s. We know with absolute certainty it is never, ever returning to 50 again. Stocks can, and absolutely do, advance to a point where they just never revisit their previous lower levels. And this brilliantly illustrates that point. Let's talk about the historical price action of linear technology. Over a period of 1,491 trading days, this specific stock hit the new highs list 157 times. I mean, that averages out to hitting a brand new high about once every 2 weeks. And you know how many times it hit the 52-week low list during that massive run? 0. Not once. If you were sitting on the sidelines just waiting for a good pullback to buy in, well, you would have completely missed out on the whole ride. To put that into perspective, just listen to these stunning historical returns. Fastenal up over 381,000%, Linear Tech up over 151,000%. We're talking Jupiter National and Mid-Atlantic Medical both crossing 271,000%, and Micron Tech up over 95,000%. These massive, almost unbelievable gains visually justify a really hard truth. Holding on to expensive, upward trending stocks is the real secret to wealth. If you lock in early profits just because a stock feels too high, you are literally robbing yourself of these life-changing trends.
Section 4, Fatal Investing Mistakes.
So why is it so incredibly hard for us to just hold on to winners? Well, it's because our hardwired emotions, fear and greed, are the true enemies of our portfolios. There are a few common emotional traps that just destroy returns. First is plunging. That's putting way too much capital into a single position all at once. Doing that instantly puts you in a highly emotional state where every little tick up or down triggers fear or greed. Second, failing to cut your losses out of sheer denial. And third, selling winners way too soon based on totally arbitrary target prices, basically just to lock in a small gain so you can feel secure. Let's completely reframe how we think about holding those losing stocks, and we're going to look at it through the lens of opportunity cost. If your $10,000 investment drops to $8,000, Holding onto it isn't just risking further financial loss. Actually, you are actively missing the chance to pull that $8,000 out and deploy it into a stock that is currently making new all-time highs. Time is money, you guys, and holding a loser bleeds both your capital and your time. Oh, and another massive trap is relying on traditional valuation metrics. We're always taught to hunt for low PE ratios or low book value to find these supposedly cheap stocks. But here is the reality check. Stocks fallen in price with low book values are usually cheap for a very good reason. Usually it's a substandard return on their assets. Traditional book value completely ignores the true value of a firm, which is human capital and strong market positioning. Seriously, do not fall for the illusion of a cheap stock.
Let's move to Section 5 and see how this builds. Picking winning stocks. To fix all this, we need to establish firm, mechanical rules to permanently replace our old emotional habits. It all comes down to following these highly logical steps. 1. Set your exit plan before you even buy the stock. Why before? Because before you own it, you have no emotional attachment to it. It's the absolute only way to make a purely rational decision. 2. Cut your losers quickly to stop the bleeding. And 3. Let your winners run without arbitrary price targets. Remember, the upside in a stock is completely unlimited, but your downside is strictly capped at what you put in.
So, the million-dollar question, how do we actually find these winners? It's simple. You look at the daily new highs list, you buy stocks that are hitting new all-time highs, and you completely and totally ignore the 52-week lows list. To succeed, you literally must systematically eradicate the appeal of buying declining stocks from your mind. That is exactly where amateurs lose their money and where professionals step away. Bringing it all back to our source material, the 5-minute investor. Mastering these few unorthodox truths takes very little time to understand, but applying them methodically, avoiding the noise, managing your emotions, and actually sticking to your plan, that is what yields a lifetime of compounding results. I'll leave you with this final, provocative thought. Are you going to keep gambling on cheap, declining stocks, just hoping they bounce back? Or are you ready to finally embrace the trend and let your winners run? Challenge yourself to apply what you've unlearned today. Because when you master your own investing psychology, you master your financial future. Thanks so much for joining me on this explainer, and I'll catch you on the next one.